Now, there's one other thing, very, very famous quote by Charlie Munger, but I think not many investors appreciate the math behind what he has to say, right? A lot of people quote him, but not many people appreciate the math behind what he has to say. And after I show you this, you will know why you want to own great businesses, right? And here's what he said. Over the long term, it's hard for a stock to earn a much better returns than the business which underlies it earns, right? If a business is earning 6% on capital over 40 years and you hold it for 40 years, you are not going to make much more from 6%, even if you buy it at a very, very undervalued price, right? Even if you buy at a huge discount. Conversely, if a company is earning 18% on capital over 20 years or 30 years, even if you pay an expensive looking price, you will still end up with one hell of a result, right? And you will understand why I only want to own steady compounders in my portfolio, why I want to own these steady growers. Any company that has a diminishing mode, I don't really want to own them because I'm always thinking very long term. And I'm going to show you the math behind this, right? If you were to look at the math of a poor business, let's say today its intrinsic value is only $10, right? And if it's only able to grow this intrinsic value at 6% over 40 years, what would be intrinsic value be after 40 years? It's going to be $103. Let's say today, rather than $10 in intrinsic value, you manage to get it at a big, big bargain. You get it at a big bargain. You only pay $5, a 50% discount at year one. After holding it for 40 years, what do you think your annualized returns will be? Let me know in the chat. What do you think your annualized returns will be? Make a guess. For those of you who have a need to calculate, you can just Google CAGR calculator on Google. You input $5 under the beginning, you put in $103 at the end period, and then you put in 40 years. Your CAGR, your annualized returns will only be 6%. This is what Charlie Munger mean by this. If a business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to make much of a difference than a 6% return. Even if you buy it originally at a huge discount. So NNA got it right, 6%. For those of you who don't believe it, you just search on Google CAGR calculator, right? CAGR calculator. And then you input $5 at the beginning and then $103 in 40 years time, right? What would be the returns be over 40 years? It is only going to be 6%. So buying undervalued business of a poor business will not make you a lot of money, even if you buy it at a big discount. But here's the great business example, right? If the intrinsic value is $10 and you manage to grow 18% for 40 years, 18% for 40 years, and the intrinsic value after 40 years would be $7,504, right? $7,504. Even if you paid 100% premium, you pay a very overvalued price, right? When you buy it at year one, what do you think your annualized returns would be, right? What do you think your annualized returns would be? I'm going to give you the answer. It is going to be a 16%. So Ashwin, extremely close, right? It's going to be 16%, right? So Andy, does it mean that the long-term return of a stock will converge on the ROE? Not exactly, but it will converge on the return on invested capital. It will converge on the return on invested capital, right? So Alan, 15.97%, that's correct, yeah. So if we look at what Munger is saying, if you are owning a company that's able to earn 18% on capital over 20 to 30 years, even if you paid expensive price today, you will think that it's fine, right? You will think that it's fine. And when I first learned about this quote and then I went to do the math, it's simple mathematics, but it was a mind-blowing moment for me because human beings, we are not good when thinking in exponential terms, meaning when there's compounding involved, we are not good at thinking in terms of that number. And it helps, especially today when I show you what it means to own a great business and what it means to own an undervalued but poor business, right? It's not going to move a lot of needle for you. And if any of you got this mindset shift today, right? There's a eureka moment. Type in eureka in the chat box for me, right? Type in eureka in the chat box for me. Awesome. Yeah. So the key takeaway, right? I want every one of you to really ink this into your mind, right? You always want to own great businesses because one, it is much more pleasurable to own them, and two, they make more sense when it comes to compounding. So and it offsetting all my 6% CAGR stocks. No. Please, like I said at the start of the conversation today, everything today is for educational purposes. Okay. Okay. So when it comes to this, the best company to own is what I would call steady compounders, right? And it's for a good reason, right? Based on what Munger is saying, based on what a lot of examples I show you, right? It makes a lot of sense to own great companies for a very long time. And when I look at this Buffett quote, there's a reason why he's always so happy all the time, right? And you look at this quote, I rather own a great business that earn 15% over time than a mediocre that earn 25%. The mediocre business will likely eat up more management time, present more problems, and be far more worrisome. Far more worrisome. I'm not sure if you guys have owned any of this worrisome company before, but when I own this company, I'm extremely frustrated, right? Because there are problems after problems. Whereas great companies is just extremely good performance after good performance, right? When you look at MasterCard and all this, it's just great results after great results. So I'd rather have a 10 million interest in a wonderful business that earn 15% than $100 million interest in a so-so business that earns 25%. And what Buffett is trying to say here is that he values the peace of mind and lower stress that comes with owning exceptional businesses.